For more on the markets, we want to bring in Sam Stovall, who is Chief Investment Strategist at CFRA Research. Also, Liz Young, who's the Head of Investment Strategy at SoFi. Let's find out where each of you are on that consensus view that Mike was just talking about. Earnings recession, earnings drawdown, however you want to call this. Sam, what are your expectations for the first half?
Good morning, Becky. Well, interesting that we were focusing on home builders because home builders since 1990 have been the best performers in December. And I remember writing about talking about buying straw hats in winter and overcoats in summer, basically hit them where they ain't. And certainly that's what home builders have done. But I would tend to say that I'm in the camp along with the majority that are indicating that it's going to be a tale of two halves. The first half is likely to be fairly weak. We are looking now at an earnings recession. The last quarter of this year, first two quarters of next year now expected to be negative, along with the deeply inverted yield curve, the negative leading economic indicators, et cetera. I think it's setting ourselves up for a fairly challenging beginning of 2023.
But when you say a tale of two halves, you mean the second half of next year is going to be strong?
Exactly. I think, or at least the potential for a recovery. I don't really see the Fed hiking rates beyond the March FOMC meeting. We do have a target at 5 to 5.25%. And I'm also encouraged by the fact that since World War II, the Fed has started to cut interest rates an average of 8.5 months after their last rate hike.
Liz, how about you? How do you come in on this question?
Well, if we start with earnings, right now, if you look at just year over year, 2023 versus 2022, consensus is estimating flat, basically, growth. I think it needs to come down from there. So as we start 2023 and get announcements from companies about Q4 and start to get guidance for the rest of the year, I would expect earnings to come down and probably show an estimate of, say, 5 to 10% contraction year over year. Now, there's a lot of belief about a weak first half and a strong second half, at least in the market. If you believe that, I think you also have to believe that we probably fix the inflation problem in the first half, which might require a recession, and then we're on our merry way in the second half. And I think actually the big risk here is that if we do have a recession or if we sit in this stagflationary environment, that it drags on longer than people expect in 2023. So actually the best case scenario is that we have a big stab down in the first half, get it over with, and then move on. But I am still a little bit worried that we're going to drag further into 2023 with inflation than people expect.
So, Liz, Wall Street always acts early. It acts on what it sees coming down the pike. Is it too soon to start buying on a second half recovery?
I think it's a little too soon. And what I would watch is some of the levels on the S&P when, if we get down, let's say, closer to where we were before the previous low at 35.77. If you look at what would actually be a 30% drawdown, which is usually a recessionary drawdown, 30% or more, you have to get down to about 33.57. So there's a long way to go between now and then. I would say if we get down to 3,500, start approaching that level, you can probably start dripping in. It may go down further from there, but you also want to watch the PE multiples. We had gotten up to 17.8 times in this last rally, which was just a little bit ridiculous considering the environment. I think if we get back down under 17, we're there now. But if we get closer down to 16, maybe even under 16, then it looks a little bit more attractive.